Association of Financial Advisors of India. Knowledge Series in association with Resurgent India ICICI Bank presents a virtual seminar on Export Finance, PCFC, EPC, EBN, Factoring. Moderator Mr. K.K. Gupta, Director, Resurgent India Limited. Mr. K.K. Gupta is the Director at Resurgent India Limited, specializing in corporate finance and management consultancy for SMEs as well as large corporations, handling substantial financial transactions. He also serves as a task force member for government MoUs and on the grievance committee at Power Finance Corporation. With a 36-year banking background and a tenure as General Manager at Central Bank of India, he holds degrees in economics and bank management. Key speakers: Mr. Gaurang Vaswada, Trainer, ex-banker and partner, FEX Fin Associates LLP. Gaurang Vaswada is an ex-banker with over 37 years of experience, having worked with the Bank of Rajasthan and ICICI Bank. He holds an honours degree, KEB, and multiple certifications from IIBF. His expertise spans trade finance, forex treasury, and trade compliance. He has held senior roles including Head of Forex Treasury and Head of International Banking at the Bank of Rajasthan and SME Trade at ICICI Bank. Gaurang has been a resource person for the Indian Institute of Banking and Finance and has conducted extensive training for bankers and exporters post-retirement. He has spoken at over 90 seminars organized by FIO and is a guest faculty at various institutions. Gaurang is also a partner at FEX Fin Associates LLP, specializing in FEMA, export, import, trade finance, and trade compliance consulting. Mr. Santosh Pandey, Product Manager, ICICI Bank. Mr. Santosh Pandey is a commerce graduate, KEB and MBA in Foreign Exchange Business and International Trade. He has more than 15 years of experience in trade and treasury. He has handled corporate relations across various segments and has been associated with ICICI Bank for more than 11 years. He currently holds the position of a product manager with the bank. Ms. Hiral Mashru, Product Manager, ICICI Bank. A chartered accountant with 9 years of experience in the banking industry. Hiral specializes in handling capital account flows and related FEMA compliance and reporting.
Good evening, friends. Good evening, friends. I am K.K. Gupta, your host today. Association for Financial Advisor of India, Research in India, with the ICICI Bank, we extend our heartiest welcome to our participants. We are having more than 500 registrations with us. And under the banner of the association, this is our 43rd webinar. And under the banner of the Research in India, so we have completed 219 webinars under this series to depict on all sectors, whether you talk the SME sector, infrastructure, or anything, that we have tried to cover it. So we welcome our eminent speakers. The introduction which we have already given to you, Shri Gaurang Sir, Mr. Santosh Pandey, Mr. Hiral. So they are covering different topic on the subject. The main subject which we are talking about, the RBI guidelines are parameter relating to the export finance. And we are talking about the ECGC requirement. Third, we are talking about the factoring as an additional window for hedging finance, which will talk to you, Mr. Saurang sir. And we also talking to the pre-shipment credit and negotiation of the export bills under letter of credit. That is being covered, Mr. Pandey. Now further we are going to talk to you, which are major aspects of the capital account transactions. which will be covered by the Hiren, our Madam Hiren. So you are aware that the macro enterprises saw increase in share in the export in India in January to 6.63%. 96% of the industrial units belong to small companies in Indian economy and account for 40% of the national overall productions and 42% of Indian exports. So you see that the SME sectors, even for the industrial sectors, they are playing very important role for exports. When we are talking about the export outstanding for the Indian banks stood at 20,489 crores as on January 24. Mercantile exports and import of March stood at US dollar 40.168 billion and 57.28 billions respectively. That means the import is much higher than the export. The trade deficit narrowed to 11 months low, that is US dollar 15.60%. When we are talking the current account deficit and balance of payment forecast stood at US dollar 28 billion, that is 0.8% of our GDP, and USD dollar 58 billion respectively. That means balance of payment, other things is also in deficit when we are talking about. So major aspect, why we this having the webinar? When my participant, my member was asking why we are asking for the export finance. Because SME sectors, as you know, playing major respect, whether you are talking about the industrial production, whether you're talking about the exports, and how the SME sector is getting assistance from the banking sector. So ICICI Bank is playing very important role to give export finance. So we want to know from these people, from the officials from the ICICI Bank, how they are helping the SME sector, how they are helping the pre-shipment credit. What is the pre-shipment credit and what is the post-shipment credit? What is the guarantee curve? How they are getting the guarantee? How the advance are being covered if this political some instability is there, some party is not paying, wire is not paying, factoring under the factoring, whether it can be recourse or without recourse, that we are going to talk. And what about the negotiation of the bills? How the bills are being negotiated under the LC or otherwise also. That is also important aspect which we are going to talk. So mostly these people, what is RBI guidelines that we are also going to discuss. Now my request to all the participants is there who are listening to me on this platform or the electronic media or a YouTube or any other Facebook, please give your feedback to us. Give your questions to us so that our experts can give you reply. So once you attend this webinar, so you say you get something from this webinar, because this is one of the most important webinar. I'm really thankful to the ICICI Bank who thought to join with the Research in India, to join with the Association for Financial Advisors, to advise, to inform our members, to inform the entrepreneurs, what are the benefits, what are the schemes, how the ICICI Bank is helping to them. So I'm not taking much time. Now I'm requesting the Saurabh sir to please give your view in respect of the RBI guidelines and ECG requirement and negotiation export bill under the LC or confirm order also. Please. I hand over to Mr. Saurabh sir. Saurabh sir. Please, Saurabh sir, please go ahead.
Am I audible now?
You are audible.
Okay.
Please.
So good afternoon all. Thank you, Gupta sir, for the introduction. Thank you, ICICI Bank and Research in India and the financial analyst of India for inviting me here. And as covered by Mr. Gupta about the need for export finance. So the view here is that we must understand the subject, we must understand the RBI guidelines, and from there we must take it forward so that we can run faster on the track to grow exports. Now, just some of the numbers Gupta sir told while I'll share my presentation and then we go from there. We are around 460 billion on our exports, and right now around 40 to 45% of the exports is being contributed by MSMEs. And we are on the way or on the path to go to $1,000 billion by 2030. In this run-up, the banks will have to increase the flow of export finance, and the requirement of export finance with the corporates will grow, and the need to understand the subject of export finance is also there, so that we are at par with how the banks talk to us and how we are handling the subject of finance. I'll just share my screen, and from there we go on the subject. So the screen is visible, sir?
Yes, visible. Please go ahead.
Okay. We go here from there. Topic of the day is export finance. Now, when we talk of export finance, the first word is exports. What is exports? So FEMA very clearly says that exports, in whatever way you call, it is taking out of India to a place outside India, any goods or provision of services from India to somewhere else. Both the things are covered here, goods and services. The other aspect is that we also sometimes cover goods supplied within India, but covered under the definition of deemed exports. So that is another segment where we can draw and we can call it an exports, which contributes to in some way or the other in earning of foreign exchange to the country. Now, the essential requirement is that whenever we are doing exports, the systems or maybe the FEMA desires that the payment should be received from abroad. Now, this could be foreign currency or rupee, various modalities are there. I'll not go into those details. When we talk of exports, our cycle, how does it work? As an exporter, we need to have a buyer identification. Then it leads us to creation of order. It leads to shipment of goods. It will go through the payment mechanism. But whether I'll be able to complete this cycle or not, I do not know. My capital is not always sufficient to cover the entire cycle from order till payment. So there is a gap of finance between order to shipment and another leg of shipment to payment. This lag is where the government wants or the Reserve Bank of India desires that if we are getting orders, then finance should be made available by the banking system or some other channels so that those orders can be executed and export should not be stopped or they should not get hampered. Then what export finance is? Export finance, which is allowed for promoting exports. It is general finance, but why a separate terminology? Because it is required to promote exports. We need exports to earn foreign exchange. We need foreign exchange to cover our imports and bridge the trade gap. We are around 450-60 billion now. Our imports are around 760-50 billion now. So almost a 300 billion gap is there already. How do we cover that? We need to earn foreign exchange. We need to grow exports. Then the exports given to domestic tariff area and SEZ units, all as also deemed exports where the goods do not go out of the country. Now, this is where whoever is contributing to exports, whoever is contributing to savings of foreign exchange into India by way of deemed exports. Deemed exports is what I supply into India and save foreign exchange, maybe against advance prices, EPCG, or any other modalities where we have a global funding tools are available. Now, finance is available or should be available for procurement, processing, manufacturing, and packing of goods. And on the other hand, finance should be available for when I raise a bill, that is export receivables. Because Up to packing, one stage is there. Next stage comes on the when I raise a bill on the bank. So it essentially means that export finance is a two-level finance. What is it? One is pre-shipment or packing credit or whatever nomenclature is. Somebody calls this export packing credit, somebody calls packing credit loan, somebody calls PSL, pre-shipment loans, etc. Some different terminologies are being used by different banks and maybe exporters. But it is essentially for financing the purchase, processing, manufacturing, or packing of goods prior to shipment. The important word here is that prior to shipment. Now, this is what the working capital requirement. Prior to shipment, whenever I am going to purchase, process, manufacture, one stage is there, pre-shipment. If I am talking about the service sector, then in that case, I will have to provide this as a working capital finance. Service sector, what is the working capital? The requirement to pay salaries, the requirement to pay rents, the requirement to pay the huge electricity bills. These are all working capital expenses because they have a cycle to drop bills on a month-end basis or in a quarter basis, etc. So that will all be covered under the pre-shipment time. Taking this forward, once I made the shipment or given the services, I will raise a bill. Now, this is essentially a bill finance, which is called post-shipment credit, and which is what? Loan or advance granted or any other credit provided by a bank to an exporter after shipment of goods. So, essentially, when I ship the goods, I get a bill of lading, airway bill, courier receipt, transport receipt, etc., and I'll draw an invoice. And in our controlled regime, we also have a shipping bill to show that customs has approved the goods to go out of the country. If it is services, then if I have rendered the services, I'm raising an invoice, the other party says I have received the services, so it becomes a post-shipment. We then take forward to the guidelines relating to pre-shipment and post-shipment, and therein I will cover the processes or how this is being handled and how exporters should handle this. Pre-shipment credit, EPC, PCR, PCFC by whatever they. It is a working capital facility. We already covered this. Procurement, processing, packing until shipment. Shipment should not be made. If the shipment is made, it goes out of the purview of packing credit. It could be fund-based. The bank is giving the money in your hands by way of credit to your account or by way of paying to your suppliers. It could be packing credit, it could be PCL, which is in rupee, or it could be pre-shipment credit in foreign currency, which we call it as a PCFC. PCFC. Okay. Now, this could also be a non-fund-based facility. And largely when we cover across even large corporates, they say, sir, our limits is not sanctioned in this manner. How? I have got a supplier of raw material who says, I am going to give you a 90 days credit against Inland LC. My bank says, I am going to give you packing credit. That raw material is being procured for manufacturing of certain goods for exports. I am eligible to draw packing credit, but I don't want money now. I want money after 90 days. My supplier is giving me 90 days credit. Why I should pay him cash or upfront? I will pay him at 90 days, but 90 days I want an LC facility from the bank. So my credit would run for 90 days as a non-fund based facility by way of an inland LC or a standby credit. And once that 90 days credit is over, to pay to the banker, whoever has discounted the bills, I have to pay by debit to my rupee loan account. And then the interest starts. I am saving on that interest part. What I need. How do I tell the bank that I have received an order or I need a packing credit? It is not a running account. It is not a cash credit. It is not a checkbook facility. It is, I have to show to them a confirmed order or a letter of credit. Sir, I have received this $50,000. I need, you have sanctioned me the limits. Within those limits, I need this. every time I need to submit. Now, what this means that this is a transaction banking. For each transaction, I have to engage with the bank. The banker would open a separate national account for each of the disbursement within the overall limit. So I have a 5 crore limit or a 2 crore limit. Within the overall limit, there is a separate drawing each time against each order. So separate national account for monitoring the due date, for providing me the concessional interest rate, and to target or to link that to a national due date. I need to have a national due date, 90 days from shipment or 90 days drawing, etc. Drawings on FOB value. Now, when the pre-shipment finance is only up to shipment, it means it does not include the shipment. So bank does not finance against my own profit margin, the freight cost, and the insurance cost. So when the goods are ready, then up to the shipment stage, bank will finance me, not for the freight and insurance. So how do I work out? So even if I have gotten CIF contract, cost, insurance, and freight, bank will first deduct certain percentage of the value by way of freight and insurance. Normally, it could be 12% or 15% of the freight, depending on the tenor, because at times the freight charges are too high in a sector. So banks, as per their own, but normal is 10 to 15% of the value. 2% of the value for insurance. And then the FOB value of the order can be added. And from there, they will deduct this prescribed margin, which is they calculate it as a profit margin. So maybe for a $100 order, I may get only $70 or $68 funding because the rest is my profit or the cost of freight and insurance. For how much time should I get? Packing credit. Each industry, each manufacturer, each processor, each merchant trader would have a different requirement. Somebody who is just buying the goods, putting his own label, repackaging it, and putting in containers and selling on site will have a requirement of maybe 15 to 30 days. Somebody who is purchasing certain items, doing some value addition may have a requirement of 60 days to 90 days. Somebody is doing an end-to-end processing may have a requirement of 180 days. And somebody who is manufacturing turbines, etc., may require about 270 days or 280, 290 days or so, 300 days. It will all depend on your business cycle. And I cannot demand from the bank that I want for 180 days, even though I am buying ready or I am buying on credit. No, the funds are to be used for the purpose of packing credit only for procurement of the goods and maybe till the time you are shipping. So it is on the individual business, it will be there. But the last point is 360 days. I will not get pre-shipment finance for more than 360 days, even though if it is extended. So if I take it for 90 days, I can extend it to 180, 180, 270, 272, 360 is the maximum. Maybe there is a problem, lockdown, I cannot produce, the buyer says it is delayed, there is a war going on, cold war going on, all those things are there. But from the date of advance, maximum 360. So this is the last line. So in COVID, we saw, during COVID, RBI had made this at 15 months. Extension of 3 months was granted. But now it has come back to 360. I have availed packing credit. How do I adjust? I cannot ask the bank, sir, I am bringing cash. You adjust it. No. I have committed to the bank. I am taking finance for doing exports. So I will have to submit the bill. The ideal way to adjust the packing credit is submission of bill, which a bank may handle on collection, purchase, discount, negotiation, anything of that part, finance against that bill and then adjust the packing. That is the best solution. But suppose my shipment is getting delayed and meanwhile I have received an advance payment from some other order. Or maybe I had sent a bill on collection where no other advance was taken and that payment is received. I can always ask the bank to adjust my packing credit because my shipment is getting delayed against a purchase. And I can ask the bank to substitute the order. So that is always possible. Now, if this does not happen, my outer line is 360 days. If this does not happen, then In 360 days, if this is not adjusted by way of collection, purchase, discount, negotiation, or any other payment which I receive from abroad, I have to adjust it from local funds. What does it mean? It means that if it goes to 361 days, then from day one, ab initio, from day one, the date of advance, this will cease to qualify as export credit. It will be deemed as a domestic finance with an irregular tag because I have not used it for the purpose. Export finance taken, not export not done. So a defaulted export finance and then the panel interest for recovering from current account or the funds provided domestic. I will also not get the concessional interest rate, including the interest equalization of subvention benefit. Even whatever period, past period I have received it from the bank, that will have to be repaid. Bank will recover and pay it back to Reserve Bank of India and government. Now, this is very important to understand here. The repo rate today is 6.5%. I may get export finance from a bank at 9.5%. If I'm a merchant exporter, I will get 2% subvention. If I'm a manufacturer exporter, MSME, I'll get 3% subvention. My net cost is say 6.5% if I'm an MSME. If I do not repay at 360 days, the original rate is 9.5. The domestic rate is 11.5. The defaulted rate is 15.5. And there could be another panel interest of 2%, 17.5. Bank will charge from day one 17.5. This 3.5 is 3% subvention is also recovered. So my cost is what? 6.5 versus 7.5. How do I survive? 7.5, no exporter will survive if the cost of funds is 7.5, I'm sure. So please see, your packing credit does not go to this limit that it breaches 360 days. You can always get it extended, we'll cover somewhere. Now, if I have a good track record, okay, first requirement was that I'll have to show the order or an LC to the bank. But if I have a good track record, I am dealing with a bank with a couple of years, I am an exporter of repute. I am a star export house, 2, 3, 4, 5, anything could be there. Or I am a unit in EPZ or EPZ or SEZ where the dharma is export, where dharma is exports. So bank may permit to give you packing credit without submission of order and which we call it running account. What is running it? My factory is running. Order or no order, I cannot stop production. So RBI guidelines say you should not stop such facilities to a manufacturer exporter, particularly if he does not have an order, give him time to procure order. And what is this time? To submit the copy of order or an LC within a reasonable time of 30 days. So I get 30 days because at times what it happens, there's an order, but because of some finer point, maybe pricing, shipment date, some quality issues, or some maybe specific requirement about print, quality, etc., that order is not being released. The buyer is still reluctant to sign an order. Why? Because I'm finalizing some specific parameters for him. It is nothing to do with pricing also, shipment also, some specific requirements. And the order is not getting. Should I stop my factory? No. I will require funds. I will have to procure goods. But it is in a running state. So this is running account. And the adjustment here is done on FIFO basis, first in, first out. Now, this facility is not allowed to sub-supplier. Sub-supplier is another breed who themselves are not exporters. We'll cover in the subsequent. What is sub-supplier? One party which has received an order is an export order holder. He does not do anything. He procures the material, maybe finished or semi-finished from some third party who is a manufacturer. This supplier does not want to get indulged in this export-related processes or etc. So he says, I'll manufacture and give it to you, you sell it in your name. This becomes a sub-supplier. Now, who is contributing to country's exports? While the export order holder is there, knows the market is procuring the order. but the sub-supplier is the actual party who is manufacturing. So we may have several such people around us who are manufacturing goods and giving it to the exporters, but still availing cash credit limits at 11.5%, as per my example. They are also eligible to draw concessional finance and the subvention of 3%. Manufacturer, sub-suppliers, 3% under MSME. Sharing of between the export order holder and sub-supplier. So maybe our 90% work is done by the sub-supplier and 10% work is done by the export order. So if in an order there is a packing credit requirement of 1 crore rupees, up to 90 lakh rupees for say 4 months period can be taken by sub-supplier, and that 10%, 10 lakh rupees can be taken by the export order holder to complete the finishing work, etc., for a period of 1 month or so. This way, this can be distributed. Another tag is deemed export. The goods do not leave the country. They are within the country. But the payment is received in free foreign exchange or Indian rupees by way of multilateral funding, etc. The original definition, goods should go out of the country. Extending that, the government said the person who is giving the goods in India instead of importing it is also somebody who's contributing the kitty of foreign exchange to the country. So that way, they are also eligible to receive the packing credit or pre-shipment finance from the banking industry. And in my view, they are also eligible to receive the 3%, 2% subvention. Now, there are a lot of areas where deemed exports can be. Somebody is having an advance authorization for import of raw material. He has already taken an advance authorization from BGFT, but he finds somebody who can give the equivalent quality of goods somewhere in Chennai or somewhere in Kolkata or any part of the country. I decide I will not import. I will endorse my advance authorization in favor of that supplier, and that supplier is then eligible for deemed exports and the facilities. There is a global tender going on, maybe for laying down this high-speed rail between Ahmedabad and Mumbai, the bullet train project. Now, there the funding is coming from the Japanese financiers or the World Bank finance projects like maybe thermal power projects or certain other projects which are going on across the country. If somebody is doing work for that, including the services part, I assume, then the money is coming in dollars. Instead of this service or these goods being procured from Japan or Europe or Dubai or USA or UK, my own partner, my own countryman is providing. So he is retaining those foreign exchange here in India. Hence, he is a deemed exporter and he is getting this benefit. Pre-shipment credit in foreign currency. The guidelines discussed earlier will cover pre-shipment in foreign currency and pre-shipment in rupee also. The only differentiator is that my costing or my pricing of the loan. Pricing of a loan in a rupee loan is linked to repo rate now or any rupee benchmark. It could be treasury bill rate. It could be 90-day paper rate. Anything could be there. On the other hand, packing rate in foreign currency, I have to mandatorily use LIBOR or Euribor earlier, which has now been taken over by alternate reference rate or SOFR, secured overnight funding rates. I have an order in dollar, but I can take euro against that. So I can avail any one convertible currency, and PCFC can be allowed in the currency of invoice or in any other. Now, this is what earlier the bank is putting rupee in my hands or to my supplier. Here the bank is giving me dollars in my hands, saying these are the dollars, what you want to tell me. Either you want to convert it to rupees or you want to remit for your import procurement. So that is possible. So interest rate is alternate or SOFR. Maximum period is here is also 360 days. Now, in certain cases, packing credit is required sometimes in the excess of FOB oil, like exports of soya meal, exports of cashew nuts, etc., where I have to procure raw material for say $200,000, $2 lakh, and my export is for $1 lakh only. Because cashew shells will be taken out. Raw cashew will be there. Out of that cashew, maybe again sorting will be there. Or there is a hand-picked sorted HPS groundnut, very fine groundnut going out. Now, very fine groundnut is sorted here. Something is sold in India. So excess on FOB has to be taken in rupee, whereas the FOB value of the order can always be taken in dollar. Now, between a sub-supplier and the exporter, that EPC and PCFC can be shared. So the sub-supplier has to take rupee finance. The exporter or the person who has got the order can take finance in rupee or dollars. PCFC is not allowed to sub-supply, so he has to mandatorily take it in rupees only. How do I disperse dollar funding? Bank will say, we have sanctioned or we have allowed $50,000 to you against an order. Do you want it for domestic inputs? Maybe procurement of domestic raw material. So they will convert those and provide rupees in your hands. If I say I want this to go out for imported inputs, then bank will directly remit that $50,000 to a supplier, say in Hong Kong or Singapore. So both ways. But this money cannot be kept in EFC account. The way I can park my PCL, rupee packing credit, in my rupee current account, I cannot park my foreign currency PCFC into EFC account, that is exchange under foreign currency. The liquidation is the same manner. Bill purchase discounted, negotiated, or I have received some other payment, or I have balance in EFC account, from there I can take. Now, when I am taking the loan in foreign currency, bank is running two risks. One risk is relating to credit, and another risk is relating to our foreign exchange risk, because they are giving dollars in my hand. If I am not able to pay dollars, then what? So bank will continue this risk up to a certain period, but after that they will not do it. So what they do? They will generally wait up to 30th day from the due date. 30th day from due date. If till then I do not get the payment or I am not giving the bill to the bank, then they will necessarily convert this foreign exchange risk into rupee risk again. It is known as delinking of the liability, foreign currency liability from the loan liability. And in other terms, we call it crystallization. Now, it necessarily means that the bank is nominally selling dollars to you. I do not have a dollar. So bank will nominally sell dollars to me at its TT selling rate, and then there could be an exchange difference bank will recover. So always be aware that I should not go into this delinking or crystallization process. Try to adjust the PCFC in time. We now move to post-shipment finance. One second.
एक मिनट सौरभ साहब.
Yes, sir.
Just I want to know from a SME sector, who are a manufacturer, what they are not exporting the goods to the any foreign country, but they are selling to a merchandise people. You can say agencies, export agencies. How they can get the benefit under the pre-shipment? Very possible. Because
So they have to.
India, India, they are exporting. Okay.
Yes.
So how they can get the benefit under the pre-shipment credit? You get my point?
Yes, sir. Yes, I got it. So the domestic manufacturer who himself is not exporting,
Yes.
has to tie up with the actual exporter and get an endorsement of that order in his favor.
In his favor.
Yes.
Okay.
By way of endorsement of an order or by way of an inland LC opened in his favor.
That is not possible. That is not
Where
so the merchandise will not endorse any LC or you can say buyer.
So I'll tell you, sir. So the domestic manufacturer will get an order from the merchant exporter where he declares that I am procuring these goods for exports.
He is declaring. He is declaring that I
He's
want.
declaring. Now,
Yeah.
on this basis,
Okay.
the domestic manufacturer has to approach his banker that I am manufacturing goods as a deemed exporter or as a sub-supplier to the exporter, and I must get this pre-shipment finance in rupees and the benefit of the subvention or the interest equation also.
Well, that is possible. That is
That is
possible.
possible, sir. That is possible. And ideal situation is there if I am a merchant exporter.
Naturally.
I should always ask my suppliers to have the banking relationship with the same bank. So there is no tussle at all. Largely, it is not possible practically, but if it is possible, if I have a maybe one single source of manufacturer for me, I should try to bring him in my own bank so that the paperwork is no issue there.
Okay. If that can be done, it is possible. Otherwise,
Yes.
also possible.
Otherwise, also possible. You have to engage with the bank, explain the documents, whatever additional declarations they require. They may require a declaration from the bank also that the documents have been submitted or the order has been
So
received,
how the
etc.
PC outstanding will be adjusted by
Yes, sir.
the merchant?
They will have to carve out a limit out of the CC. They will carve out the limit as pre-shipment finance by earmarking CC and doing it.
Yeah, I'm not asking how the PC will be adjusted, because
PC will be adjusted by payment which is made by the merchant exporter to the sub-supplier.
that can be done.
That
That
can.
can also be done.
Yes, sir.
Okay. Thank you. Thank you.
So we have already maybe set the role for the pre-shipment finance or the pre-shipment in foreign currency and drawn the credit, seen the nitty-gritties of it. Most importantly, do not cross that 360 days so that everything goes into penalty. Try to be within the 30 days from the due date so that your PCFC crystallization does not happen. And if it is overdue, then we have to pay additional interest. Now on the post-shipment, as the name says, loan or advance granted after shipment. Now I have to tell the bank I have made the shipment. How do I say? By giving the bill. Bill means commercial invoice, maybe additional documents like packing list, certificate of origin. But what is the transport document is important. Full set of bill of lading, airway bill, courier receipt, etc. And in our case, shipping bills also. When I give the bill to the bank and tell them that, sir, this is the bill $50,000 against which you have given me $40,000 equivalent packing credit. Bank should allow post shipment and adjust the pre-shipment. And this will continue till the bill is realized. There we have a due date. Here we have to calculate the due date for the realization. We'll see how. Now, when the bill is financed and the foreign bank, when it is paid and the money is received from foreign bank, it is automatically adjusted. And because of that, we call this bill finance as a self-liquidating. This can also be given in rupee, means linked to repo rate or T-bill rate, etc., or in foreign currency linked to SOFR or any other alternative. Now, bank will always keep a margin because bank does not fund the profit. Our profits are not too high, so bank normally will keep a margin of say around 10%, or maybe with the clean finance, users bill, etc., maybe around 20% or so there, but normally margin is kept. Bill finance bank is purchasing or discounting the bill. They are purchasing or discounting the bill of exchange which has been drawn on the buyer. So, and the bill of exchange is drawn in foreign currency, $50,000. So there is an application of the rate there. Today, what is the rate as per the forward calculation? I have to prescribe that rate, and on that rate, I will discount this. The interest for the period from today, the date of bill purchase discounting, till the notional duties is recovered upfront and balance is paid to you. Bill should be liquidated from the same bill proceeds. And when the bill is paid, bank is supposed to charge the interest up to the date till which it has received the payment in its nostro account or vostro account. So if the bill is paid, say on 1st of January, and the information comes on 2nd of January in the treasury of at maybe Mumbai, and the buyer or the exporter say is in what you call somewhere in Haryana, Panipat. Next day, the Panipat branch receives an information. In 2 days, they approach the exporter. The exporter says 50% you have purchased, 50% I want in EFC. Then the information travels back. From Panipat, the Mumbai branch or Mumbai back office then reverses the entry on 7th of January. The actual accounting date is 7th. The interest is not to be charged up to 7th. The interest is to be charged only up to 1st of January, the date on which the bank received 50,000. So there is a rule of validating the entry and interest for post shipment, not in any other. Now, in three types, the bills can be financed. One is purchased. Our all side bills are purchased. Non-LC side bills. Non-LC usance bills are discounted. And if it is a letter of credit bill drawn under letter of credit, either side or usance, it is negotiated. The terms are used in similar manner. Side bills, foreign bill purchased. Usance bill, foreign bills discounted, and foreign bills negotiated for LC, whether records or without it. Now, this nomenclature of FBP, FUBD, FBN could be different in different banks. Some use XBP, XRP, XBD, X for exports and bill discounting. Then P will be there for purchase, X for exports and P. So different nomenclatures will be there, XBN or XEN, etc. Anything could be there, but irrespective of the nomenclature, the three important aspects are purchase, discount, and negotiation. Besides that, in some of the industries or the larger exporters, they decide and finalize their exchange rates as per their own market or treasury operations. They have a separate treasury. So they insist that bank should not use the rate as on the date of purchase discount. You may give me the rupee finance. Do not lock the rate for me. I will manage my own foreign exchange risk. Because here in FBP, FUBD, FBN, the bank decides the rate and locks the foreign exchange rate. So it is taking over the risk from them, from the exporter. Here the exporter himself keeps it. So it is a rupee finance, another window where the post-shipment finance can be given. Now, necessarily, if I have taken PCFC in dollar pre-shipment finance, rupee finance post-shipment should not be used. I have to use FBP, FUBD, FBN only in dollar terms, not also in rupee terms. Now, FBP, FUBD, FBN can be in rupee interest rate also or dollar interest rate. The tenor is linked to the tenor of the bill. If it is a side bill, we have to calculate a normal transit period, and as per FEDI rule, Foreign Exchange Dealers Association of India rule, it says for all foreign currency bills drawn abroad at site, you have to allow 25 days normal transit. It means I will be able to get the concessional finance for 25 days. So from the date of purchase till 25 days, I will arrive at a notional due date for the side bill. I apologize, there's a spelling error here in site. Sorry. On the usance bill, I have to calculate a notional due date. Now, notional due date is what? Say a bill is to be drawn at 90 days usance. 90 days usance, the intention is that 90 days from the date it is accepted by the buyer. So I will keep 90 days and I will also allow this 25 days normal transit period. 115 days concessional interest is available to the exporter. But this period cannot be more than 365 days. So if I am drawing a bill for a year or 360 days, still I will get only 365, not more than. Now, another type where the bill could be drawn is 90 days from shipment date. So then this 25 days period is not given. I have to calculate 90 days from the shipment date and accordingly do it. So maybe if I am giving the bill after 10 days or on the 11th day from the shipment date for purchase discounting, I will get only 80 days concession. These rules are sacrosanct for all banks. The calculation of normal transit period or notional due date is a FEDI rule. It is applicable to all banks. If there is an error, if there is a gap in understanding at the branch level or at the calculation level, then maybe you should always engage with the bank and try to see that things are corrected. Because I have seen banks maybe making errors here or there somewhere, and then maybe we have to get that adjusted correctly, because it will create a difference of interest, and difference of interest is what hitting our bottom. Here also the bills are purchased, so there is a concept of crystallization, delinking of the foreign exchange liability. So if the bill is not paid till the 30th day from due date or notional due date, then the bill needs to be crystallized. So I need to follow up with my buyer to pay the bill in time, if not on due date, but at least 5-10 days here or there, not more than. Now, once the bill is crystallized, the risk comes back to the export. Why I have mentioned here. When you are getting the bill purchased, the bank is applying the exchange rate. Maybe the bank is charging 10, 15, 20 paisa margin there. When the bill is getting crystallized, the bank is notionally selling dollars to you. So bank is again applying the rate with a margin of 10, 15, 20 paisa. When the payment comes, the risk is with the exporter. Again, the rate needs to be taken. The bank will again charge you 10, 15, 20 paisa margin, as per your arrangement or as per your understanding. Margins are all free to be decided by banks, customer to customer, value to value, etc. Now, what has happened? If I am able to get the payment of my bill in time, I am only paying margin once. But if it is crystallized, I am paying on the second time, and when the payment is received, I am paying on the third. It is an additional cost to me. If it is in foreign currency, the rates are linked to SOFR or alternate reference rate. It should be used must when the PCFC has been taken. Rest all rules are same for post-shipment finance, whether it is in rupee. Now, this is the general guidelines on pre-shipment and post-shipment finance. We move to negotiation of export. Negotiation of export bills under LC is particularly when the bills are drawn under LC, and this becomes a window. Now, all the previous terminology which I have used will normally be there when I get a sanctioned pre-shipment, post-shipment finance from the bank. But under a negotiation, this becomes an additional window to raise working capital, as there are no limits required by the export. It means that either I do not require the limits, or even if I have the limits, I can use this as an additional tool outside the limits, beyond the limits also. Bills negotiated by banks not under the lines used for you or the exporters, but for the LC issuing banks. Say ICICI Bank is doing a negotiation on an LC which is issued by ICICI UK or ICICI Hong Kong or maybe Standard Chartered London. They will block the lines issued to those institutions because they are different in that manner. And the limits used are not of that of exporters. The risk is taken on the LC issuing bank. So I must know who is the LC issuing bank and whether that is acceptable to my bank. The rate of interest is normally linked to SOFR, but rupee financing can also be done to avail the benefits of interest subvention. Normally, the bank negotiates, sends the document on collection to the foreign bank. Once the acceptance is received, they will give you the money here and or to check. When I go for negotiation, whether within limits or outside limits, I must ask my bank whether the LC is acceptable to you or not. LC means the LC issuing bank firstly. Secondly, the terms and conditions. So the LC is established. Before that, I should ask my buyer, please tell me which bank are you going to open an LC? And also try to get a draft LC. Get it checked from the bank. Suppose it is from a bank, say Cooperative Bank in Netherlands. I am not sure whether your bank is going to accept it or not. You have to ask. Maybe your bank or some other bank. If the bank is first class bank, several banks will come forward and do it. If not, then you are at risk because that bank is not known to anyone. Ask for a draft LC. See the terms and conditions, whether you are able to comply with that or not. And also check with your bank whether those terms and conditions are not violating, etc. Understand preparation of error-free documents. Now, this is more important. One of our seniors has said, if you do not know how to prepare documents under LC, accurate documents. Please do not entertain LC documents. Go for another clean method. That is better. Because we depend on LC, then we do not do the stringent due diligence on the buyer. And if we do not do the stringent due diligence on the buyer, and if we do not comply with the LC terms, we are of nowhere. Our transaction fails. We do not get the money, or we get the money with great difficulty. So we lose the shelter under LC UCBDC if it is not an error-free document. The condition of the LC is that I will pay only if you provide to me documents which are credit compliant 100%, timeline-wise, document-wise, signature-wise, or whatever requirements. Check whether the bank is negotiating the documents on without recourse. This is from my practical experience post my banking career. Banks say we are doing it, but they debit or block your limit. If they are blocking your limit, then what? It is a recourse. They can always recover from you. See that it is beyond your limits. The limits are not used. Or if you are able to get it from some other bank where you are not enjoying the limits, then it is beyond the limits. So it should be without recourse. It should be once the bank has given you a finance, it is non-recoverable. They should always be getting the money from the foreign bank or the issuing bank, not from you. So this becomes an additional window to risk. Now, something about the credit. ECGC is a... Yes, sir.
Sir, one minute.
Yes, sir.
So I think you are talking very nicely with negotiation without recourse.
Yes, sir.
Because one question is, when the bills are negotiated under the LC,
Yes,
whether
sir.
acceptance is mandatory. Because one question, so somebody asking, whether acceptance is mandatory for that, because the
No,
document
no.
are given as per the term of the LC. Acceptance is mandatory as per you?
No, sir, no. It is not mandatory.
Hello?
It is not mandatory.
Yes, right.
It is not mandatory. This
It
is
is not
only
mandatory.
where
Now,
it is
I
as
think
a process.
yes.
As a process, banks are using this, that they part with the funds after receipt of funds. But if they have done it before receipt of the confirmation or the due date from the foreign bank, you may find that in some places it is done on recourse basis, not on without recourse. We have seen banks doing such things.
Now the participant can understand, because once they have negotiated with the under the LC, as per the term of the LC, you submit the document, there is no recourse left with them. Okay, then they will have to negotiate the bills. Clear. I think I thankful to you. Excellent, sir. Excellent. I think this is a very
Take forward, sir. Thank you, sir. Thank you.
Thank you very much.
Now we move to credit
Carry
insurance. Credit insurance is what? I want to take shelter against the default on the buyer. Firstly, my conscience is clear. I am not going to default. So there is an Export Credit Guarantee Corporation set up by Government of India with crores of rupees of funds maybe at their disposal to give the credit guarantee to those who are exporting or to those who are financing exports. So it is a guarantee to exporters for support of export growth and also available for both goods and services. Now, even the banks are financing exports. They are also promoting export. They are also supporting export growth. So separate policies are there for banks and financial. Now, Export Credit Guarantee Corporation is under the IRDA regulations because it's an insurance, credit insurance. From the time IRDA is there, ECGC is also under the IRDA. So earlier their policies were not called policies, but they were called post-shipment, pre-shipment and post-shipment policies. Now they are all export insurance, pre-shipment insurance, post-shipment insurance, etc. They are also giving policies relating to our working capital as well as for project exports, service exports, etc. Banks, some of the banks, not all, they have taken the export credit for insurance for banks, which is on a whole turnover basis on pre-shipment and post-shipment. So some of our public sector banks and old private sector banks have taken this. Largely, as I understand, State Bank and the new private sector banks are not subscribing. So they rely on the client and the security, and if on the post-shipment if it is required, they will ask for the additional. ECGC also gives turnover-wise, buyer-wise, country-wise cover to the exporters on the bill drawing side, not on the pre-shipment. Some standard policies are there where turnover-based coverage is there. They cover the commercial and political risk, and the cover ranges from 75% to 90%, or in some cases 95% for small exposures. The coverage does not include dispute with the buyer. Buyer does not have import license, and because of that, he has not taken the goods and he is not paying. Insolvency of an intermediary party, either a collecting agent or a bank, anything relating to exchange differentials, currency devaluation, etc., or the general insurance clauses, which general insurance or the shipment related we are already covering with our general insurance policy. The important aspect here is that what is covered is the default by the buyer in the normal course of business. I have relied upon the buyer. A buyer standing was very good. ECGC has said that you can draw bills up to $1 lakh on them, or maybe 50 lakh rupees on them. I have drawn the bills earlier, they have been paying, but because of certain circumstances, they have not paid. So I must get the money. So I will get, say, 90% from ECGC, and policies, insurance policies are always risk sharing. Insurance, ECGC also is risk sharing. So 10% is my risk, 90% is the risk from ECGC. And there are specific policies. Now, if my bank is not covered, or even if it has covered and I want additional risk to be covered, then I can always go to ECGC and ask for a single buyer cover. I have found out a new buyer, say in Kenya or Mozambique. If ECGC is covering those buyers or those countries, we'll have to see whether those countries are getting covered or not. Or I have a new buyer in a new country. I will say, okay, sir, this is a new buyer. I don't want to take risk. You give me a policy for that particular buyer. Or I say that this country feels slightly riskier to me. Can you give me a policy for multi-buyer buyers in that particular country? I can do that. I can do a single consignment policy. I can do a very specific shipment policy. I can get services policy, construction policy, etc. Different parameters are there. Variety of policies are there with ECGC that will suit our requirement. And the premium could range from 0.5%, or maybe in old turnover it's less than 0.5% also, to 1 to 2%. But it's worth it. I must store my default in any case, eventuality. Why do I insure my car? One is mandatory, but the other part, because I am safe. Something happens, I have somebody to fall. Here also, something happens, I have somebody to fall. And the policies other than ECGC, there are private insurance companies approved by RDA, they also provide. And the latest one is that people are working in Gift City to have a maybe offshore insurance which will provide export finance insurance to the onshore people. That is to be rolled out very soon. Now, ECGC also provide country risk rating for small and medium-term loans, medium-term policies. So I have taken out certain risk parameters from the short-term one. A1 is insignificant, where the countries like USA, Singapore, Spain, etc. are there. A2 is low risk, where UAE, Thailand, Saudi Arabia, Philippines, Mexico is there. I have B1, which is moderately low, Uruguay, Panama, etc. Moderately risk. Now, still some risk is there. So if I am maybe going for a buyer in Panama, I can ask ECGC for a policy. Moderate risk is Vietnam, Jordan, Gabon, etc. So newer markets, if I am finding, say, Gabon, I want to enter, I can ask ECGC whether this buyer is worthy, whether you will give a policy, and then only I will conclude the transaction. Moderately high risk, Maldives, Bolivia, Ethiopia, Russia. This is only a sample. High risk is Burundi, Djibouti, Pakistan, Myanmar, Ukraine. And very high risk is Afghanistan, North Korea, Mozambique, Yemen. Now, as an exporter, I may decide I will not ship to D, C2, C1 also. If I am anytime required to ship to B1, B2, and C1, I will always go for ECC policy. And in new clients of A1 and A2, I may or may not go for ECC. You can frame your own policy. In D also, there is a specific approval required. If I want to ship anything to Afghanistan, I have to approach ECG to take a policy, even if I have taken a whole turnover policy. I have to go to them. So see that whatever conditions are there in your old turnover policy, whether you're complying or not, because insurance would like you to default in any of the conditions and not pay. Another word of caution. If your bank has taken an ECGC policy, or if you have taken an ECGC policy, and you are not an SEZ unit or a status holder, please send the original documents to the buyer or buyer's bank through the banking system in India. If you dispatch the documents directly, then the first rejection would be that you are not complied with RBI guidelines to send the document directly to the to route the documents through the banking system. So, first rejection in such cases will be this. And the last part, factoring. I think I am exceeding some time, but maybe 5 more minutes I will take.
One minute.
Yes, sir.
No problem. I just want one question. See, if the exporter need not to approach the ECC directly, it is under the whole turnover policy. So here, bank is automatically covering the guarantee, no?
Yes, sir. The bank, some of the banks are having whole turnover policies, some of the banks are not having.
No. So what the buyer should do it?
So then exporter
should do it.
So in exporter, if in his sanction it is written that your credit limits are subject to whole turnover policies or ECIB of ECGC, and the premium on pre-shipment will be charged to your account.
My only point to the listener is
Yes,
they
sir.
should see the sanction letter or should approach the bank. Whether
That's what I am coming.
Covered.
If it is covered under
Thank you.
whole turnover policy of the bank, then you may decide whether you want an additional risk cover or not. And based on that, your call, you can approach ECGC directly or through your bank also, because banks are also agents of ECGC nowadays. So through your bank or directly to ECGC and ask them on a buyer or a country on a turnover how I can take a policy on the post shipment side. If your bank is, say, ICICI is there, ICICI does not have an old turnover policy. So maybe if it is not a condition in the sanction, even then you can ask ECGC for a cover on your bills on the buyer side of risk cover. And ECGC is all across India. Almost in all states, they have got offices. Maybe there is a call center. You can log in. You can create your own ID on their website and then engage with them. Somebody will call you, help you out. If you are in major towns, you can always visit them or ask their representative to come to your office and explain.
Excellent. Thank you very much. Please
Thank you,
carry
sir.
on.
So last part is factoring. Now, factoring is also an additional tool to raise finance on the post shipment. Maybe I do not have limits. I do not have security. I do not have LC. Now, if I do not have security, may or may not be, I am not enjoying credit limits with the bank. So here on the bill side or the receivable side, factoring comes into picture. An alternative route to avail finance against export receivables, it is an approved method for financing exports. Sales ledger. Now, factor only does not pay you the money. They will manage your sales ledger. They will do the debt collection. They will also send reminders to the buyer. Your payment is due. Your payment is due after 15 days. Your payment is due after 7 days. They will follow it after the due date also. They are doing everything. But their main function is to pay you. And they pay normally 80%, 75% to 90%. Now, factoring started way back in 1999. And I still know Canback Factors and SBI Factors were the earlier factoring agencies in India. And now we have got Drip Capital, India Factors, and several others operating from India, which have got bases in Singapore or Dubai, etc. Factoring regulation came into 2011 to put everything straight. So now there is a regulation. So it is applicable to all the factoring agencies or the institutions which are promoting factoring. How does this work? There are two types of factoring. One is with recourse and one is without. Here also it is with recourse, without. Now, without recourse means that the factoring agency is going to cover your risk on the credit by doing a risk insurance and thereby adding that insurance premium to your cost. If it is without recourse, then they may call back the funds from your bank when they pay. So we should always see that it is without recourse, pay extra, pay 1% extra for insurance. do it without recourse. At least your 80% or 90% whatever you have received will not be called back. Assessment of what they do. They will assess the financial status of the exporters. Say you have got a turnover of 20 crores, 30 crores, for 50 crores. What is your last default? How your buyers are behaving? How is your old debt? They will ask for balance sheet, maybe your banking arrangements, etc. They will also do similar financial status check on the buyers and tell you that, okay, your buyer is agreeable to you, to us. On this buyer, you can draw bills up to $50,000. On this buyer, you can draw bills up to 2 lakh. So there is a buyer limit set by the factor. And then once you draw the bills, they will handle those bills, pay you upfront of 80% or 75%, or in some cases 90% also, and without that 25%. Now, once the bills are sent to the buyer pays on due date or thereafter, and the factoring agency will deduct the margin, deduct the interest and other factoring costs or overdue interest, insurance costs, etc., and pay you the balance. So out of this 25% margin, they will deduct everything and pay you at the end of the tenor. They also do the follow-up with the importer if it is not paid in time by using an import factor in the importer's country. So factoring, if I do not have a collateral, but I am supplying to, say, a very good buyer in Dubai or very good buyer manager, say Siemens I am supplying certain nut bolts to Siemens in Germany, or I am supplying certain packaging material to a very large manufacturer, or maybe to some products to IKEA. These are renowned buyers. I will get a facility from any factoring agency at a very competitive rate. I can negotiate with them. And there could be no limit. Say, they may say, okay, to Siemens, you may export up to $5 lakh, we don't mind. 180 days is also not a problem. Then I will be able to draw money on the post-shipment side and release my working capital for further recycling it. So this is an additional factor. Now, certain banks are also providing this support by way of an agency arrangement through Capital or India Factors or any other agencies, or you can directly approach some financial institutions where they are promoting factoring as a separate. I have lastly covered some of the issues being faced by exporters about the awareness, about the processes, etc. Exporters and sub-suppliers not availing export finance, there is an awareness issue. Even we find now exporters not availing export finance, but doing work on cash credit or overdraft. Somebody who is into domestic manufacturing, 90% domestic, 10% export finance. Export. Why not 10% export finance is being availed? They are all working on their cash credit working only, not taking 10%, 15%. You can always get your limits carved out of your entire manufacturing limits. Tenor of EPC is not as per cycle. My process cycle is 180 days. I got sanctioned for 90 days. My tenor of bills could be ranging from site to 180 days. I have got a sanction for site in 90 days only. You have to sit with the bank and negotiate and tell them that this could be the scenario, or maybe get an amendment to increase the cycle. Business cycles are not uniform. Sometimes I will need more for raw material. Sometimes I will have more on my debtor side. I may require interchangeability between packing credit and dollar finance, or packing credit and post-ship. As per my requirement, I may draw dollar finance, I may draw rupee finance. So there should always be interchangeability between rupee finance and foreign currency finance, and pre-shipment finance and post-shipment finance, and reverse also. Interest subvention not getting benefit, equalization because of awareness. I did not tell the bank that I am a merchant exporter, I should get 2%. I am in that 462 commodities which are approved. I did not tell, because of that I am not getting. So awareness issue again. And it is very difficult to claim subvention for the past period, although we have done that. But we know of those difficulties. Try to get your packing credit or export bill extended in time if it is not getting adjusted in time. So if you have taken a packing credit for 90 days, and if you know that shipment is not being made in 90 days, go on 85th day or 80th day to the bank, say, I want an extension for another 30 days period because my shipment is getting delayed for want of container, for want of ship, there is no sailing available, try to get it extended. Otherwise, you will pay penal interest or overt interest for 10 days. And similarly for bill also. If your buyer says, I am not able to pay you at 90 days, I want another 60 days, exchange correspondence before the due date and get it extended from the bank. Banks may also place certain restrictions on your bills drawn on your sister associate concerns abroad, or certain restrictions on, say, maybe C1, C2, D categories. Or if you are dealing in multiple commodities, they may give you peak limit, non-peak limit based on the commodity. So always try to see how to maybe handle those limits, in what times, what facilities are there, how much limit will be there. If you are in maybe woolen garments, and if you are availing peak limits, non-peak limits, or if you are in certain agri products, peak limits, non-peak limits, you should manage that. Some issues to remember. Always get your limits renewed in time. Overdue limits, this is a transaction banking. Bank will stop transaction from day one itself. Get it renewed in time. Monitor due dates for tracking credit PCFC, because it will lead to overdue interest, which is hitting your belly. Timely extension of PCFC wherever required. Application of forex rates will be there on bills crystallization PCFC. See what rates are being done. It is not done at card rate. Then monitor the bills purchase date, discounted rate. Otherwise, OD will be there. You have to talk to your buyer. Right? Time se de do, otherwise I have to pay 2% additional interest. Crystallization. If it happens, I have told you about margins. I have told you exchange rate adverse movement. Somebody got bill purchased at 82. When the bill got crystallized, it was 83. The bank recovered 1 rupee. When the bill payment came back, the exchange rate came at 81.50. I am negative 50 paisa. So this way the exchange rate may hit you. So always monitor these rates. And you can always book a forward contract for discounting of bill or for PCFC in advance. I know that every month I am taking $50,000 as PCFC. I can book for next 6 months if I know that the dollar is not going to go beyond 84.50 or 85 or something like that. Don't believe on whatever market talks. See what is happening actually. And then see, and don't be in a greed for exchange rate at least. If your cost is over, take a booking. And negotiation and factoring as an additional tool. Use this, learn this effectively. It will always help you to release your working capital for growth of exports. So we will take more questions later on. These are my credentials here, the telephone number, the email ID.
So thank you very much.
You can always take note of that and get in touch. Thank you very much.
Thank you, sir. I think you have covered very nicely. All the issue, I think this is pertaining to our listener. I think you have already nicely covered for any question will be there. So we'll come back to you. Now I'm requesting Shri Santosh Pandey sir, who is a product manager ICICI Bank. He has got 15-year experience under the field and MBA foreign exchange business. And I think his expertise in the foreign exchange. So I'm requesting which can be beneficial to the sector. So I hand over to Mr. Santosh Pandey, sir. Please give your thoughts on that respect. Mr. Pandey, sir.
Yeah, thanks, sir. Thanks a lot. I'll just move on to my session on the export finance from ICICI Bank. Hope the screen is visible.
It's visible.
Visible. Please carry on.
Okay, thank you. Yeah, so before we could move on to the export finance advantage from ICICI Bank, let's delve into the export performance in India actually. So we can see here the export performance has actually been flat actually. So we can see here that in FY23 we were close to 770 billion. In FY24 we are at 777 billion. So just a 7 billion increase in the overall exports as such. There's a slight a drop in the goods export actually from 400. It was from 447 to we have dropped to 437 billion dollars. On the services front, on the services exports, we have marginally increased by 39 billion dollars. So we were almost flat. 1.2% increase would be there in the overall exports. But looking at the international situation, I think this what we could achieve it as a nation actually. So as per the Federation of Indian Export Organization (FIO), our FY25 estimate of exports should be $900 billion. Most of it is, I think, is supposed to come from the manufacturing, e-com, and the other sectors actually. So in FY24, who were our major contributors in the exports? So we can see the sectors over here. So we have the engineering goods, we have petroleum products, gems and jewelry, chemicals, pharma, and no doubt in service sector we have ITES as a major contributor in the overall exports of the country in FY24. We move on to the MSME sector. So I presume most of our participants would be dealing with the MSME sector as such. So here you can see as on FY24 31st March 2024, the total MSMEs registered with us has been 4 crores. Most of it has been from the micro space. So the micro contribution has been 97.7% in the overall MSMEs which have got registered. MSMEs have contributed to the extent of 46%, so precisely 45.83% in the overall exports of the country in FY24. And the target of the Ministry of Commerce for 2000 till 2027 from only the MSME space is $1 trillion of exports. Now we could see the export credit market in India. So the overall the outstanding export credit in market in India has been 2,06,000 plus crores as of 31st December 2023. ICICI has a market share of close to 6 to 7% in this particular space. So before we could move on to our core topic, let's understand the advantage of ICICI Bank here. So ICICI has been with a lineage of over 60 years in this in this country, with a respected financial institution. To 23.64 trillion rupees has been our consolidated assets. Over the 6,500 branches have been opened as on 31st March 2024, and 17,000 ATMs are there in this country from ICICI Bank. So here you could see our investments and our interest in our subsidiaries. So you can see ICICI Prudential is there. It's a very important subsidiary with which is a leading AMC in India. ICICI Lombard, we have uh, our interest and investment. So, which is the fourth largest general insurance company in the country. ICICI Venture is the largest alternative asset management company. So here we have our interest. ICICI Securities has been a leading equity brokerage house in India. And last but not the least, ICICI Prudential Life Insurance has been our important subsidiary, which is the first life insurance company to get listed on NSE and BSE. So this is about ICICI Bank. So I thought we'll just take you through ICICI Bank. Before moving on to the export finance from ICICI Bank. Yeah. So this is about ICICI Bank, why you should have pre-shipment finance from ICICI Bank as such. Number one is the Insta EPC facility. So Insta EPC facility is nothing but it is basically a way of giving automated disbursements of your packing credit or drawal of your packing credit INR into your current account in less than 5 minutes. So we will discuss more in detail on this particular facility from ICICI Bank in our further slides. ICICI Bank is not charging any prepayment penalty for PCFC prepayment up to 30 days prior to the maturity. So in case if you have a maturity on 30th of on 31st of May, and you wish to prepay that particular PCFC on 15th of May, you can do so without paying any prepayment penalty as such. Quick repayment of packing credit to branches. Now we have given the powers to the branches to do the knockoff or the repayment of the packing credit in the branch itself without putting this particular request to our central team. So here the advantage is if you give the request to the branch to knock off your packing credit, same day you can avail the other part of your sanction letter. So in case you have say 1 CR, you wanted to knock off, you can knock off that 1 CR in the branch itself and take 1 CR on the same day as a disbursement of packing credit. Yeah, we have interest servicing from EFC accounts for PCFC customers, so that our large or medium size uh, customers for PCFC have raised this question of why we are not allowed to use the EFC account. So now here we are giving the opportunity to our some PCFC customers to use the EFC account to pay the interest on PCFC, so they can save on the foreign exchange. Yes, you can do the transaction digitally through Trade Online. Uh, so, so with the ease of just sitting in your office, you can give a request for a drawal of EPC PCFC from your office itself without visiting any branch. It is completely online, and you can track your transactions also over here. Yes, for some good track record customers, we have introduced this. We can say a levy or a freedom to not submit the purchase orders. Now here, if in case you do not have the purchase order on time, you can give an order statement. So in case you have an order statement, we accept that order statement in lieu of purchase orders, and this is only for good track record customers. So that there has been a hassle which many customers face with banks, as to that bank is asking me purchase order for each disbursement as such. So we have a solution here for such customers. Yes, so interest subvention scheme has been covered here. So here we give the interest subvention also to our customers. So on the last day of that particular month, we debit the interest for packing credit, and we credit the account with subvention interest. So we do a debit and a credit on the same day without wasting any day to give that interest subvention benefit to our customers. Now here we have a single dashboard. So a single dashboard has been created for our customers, where they can download 8 types of advices. So we have an advice for each packing credit life cycle. It can be a disbursement, it can be extension of packing credit, it can be repayment of a packing credit, it can be crystallization, and so on and so forth. So for all transactions, or for all life stage transactions of packing credit, we have advices on Trade One, which is one single yeah, Trade One View portal for all types of advices. Yes, the last but not the least, for customers to track their pending orders. So we normally take the purchase orders from our customers, and normally we see that they don't keep a track of it, or sometimes it get missed. So just to avoid that particular instance, we have a one view portal as such for pending export orders. So you can check your disbursements, and you can check whether you have given the purchase orders or LCs for such disbursement which you have taken from ICICI Bank. Yes. Now this is about Insta EPC facility. As I mentioned, this particular facility is provided to our customers who are lending customers of ICICI Bank, who are already existing borrowers of ICICI Bank, and here we just automate or smoothen the flow of drawal of a packing credit into their current account in matter of minutes. So in 5 minutes, in I can say less than 5 minutes, our customers are able to get the drawal of packing credit in their current account from their limit account. So this is industry first measure what we have taken, and we have got a lot of good responses and references also from our customers because of this facility. And this is only for INR customers. So just to dwell more into this particular facility, the benefits of this facility we can see here. It is instant and without any manual intervention. Money is available to the customers who are using the Insta IPC facility to meet their pre-shipment expenses. Disbursement is happening through branches or through trade online, and no additional charges. Now this facility comes with no additional charges, so you don't have to pay any single penny for the branch to avail this particular facility, and no separate documentation or application from the customers to avail this particular facility. Now here it comes with some uh, exceptions. So this particular facility is presently we have started only for EPC customers, that is INR packing credit customers. PCFC transactions are not allowed at present. This is only for running account facility customers. Customers should not be on the RBI caution list. Customers should not have the purchase order pending beyond 30 days from the date of disbursement. LEI number is mandatory only and only if the limit is more than 7.5 crores. So LEI number is mandatory only for 7.5 crores plus limits for customers. Presently, at present, we are not offering this particular facility for the diamond exporters, service exporters, and sub suppliers because we require additional documents at the time of packing credit disbursement, which is not possible online at this point in time. So that's it from my side on ICICI Bank's offer for
Thank you.
pre-shipment finance. Thank you.
Thank you. Thank you.
I lost your voice, Gupta ji.
Sir, you are on mute.
We want Mr. Pandey from you. If any faulty, our SME sector, who is not your customer, coming with your LC document in terms of the LC also, whether your bank is. Hello?
Sorry, Mr. Gupta, I could not hear your question.
Hello?
Can you repeat again?
Uh,
I
If
I was
any
not able to.
customer, he is not your customer. So age is not your customer. Okay.
Okay.
Age, you are getting me?
Yes, I could hear you
Age is
now.
not customer, he is coming with all the documents under the LC for that without any limit.
So I could hear that there's a customer
I
who's a
will come back.
non-customer.
He
Can
is
you
not
hear me?
your bank customer.
Okay.
Document to display for your bank.
Correct. So he is not my bank
So I am
customer.
coming to Mr. Meera. He is not your customer. Because he got a LC, document as per the LC. He is coming to your bank to discount it. That is possible for your bank.
Yeah. It is possible for our bank. We create only the customer ID for this particular customer by taking the KYC documents, and
Oh,
and we
okay.
we can discount that. We can discount that LC.
Okay, thank you very much. Now I'm coming to Madam Hiral. Madam,
Hello, sir.
so welcome you, madam. You are a chartered accountant. I think you are also expert in capital accounts. So may I know you how the ICICI Bank is helping in capital account transactions?
I'll
How
just,
your ICICI Bank is helping capital account transactions, please?
yeah, so I'll,
Hello?
am I
Please,
audible?
carry on. You are
Okay.
audible. Please
Yeah,
go
I'll
ahead.
just start my video. Give me a moment and
Please
I'll
have
do
your
it.
video. Have your video if possible.
Yeah,
Please carry on.
I'm sharing my screen.
Please.
Is it visible?
It is visible. You carry on. You have
Yeah,
started. Just
yeah,
started.
yeah. Hello, everyone. Good afternoon. So as we are aware, the other part of the FEMA is broadly divided into the current and the capital account transaction. Uh, Capital account transaction, the volume is unlike export import, which is day in and day out. The capital account transaction are strategic transaction, and hence it is not volume. We will not see volume in terms of numbers, but the value is very high always, and the complexity is there because of there are a lot of reporting requirement along with the settlement. So here we understand that client will would want a very focused approach for their capital account transaction, which will broadly include three major aspect. One is foreign direct investment, where an Indian company is planning to receive investment from their foreign investor. So that is one aspect. The other is in the capital account is the reverse of FDI, is the ODI cases where an Indian company wants to extend their business overseas. And the third aspect is external commercial borrowing, where the Indian companies can raise loan from the overseas lenders. And there are other ancillary capital account transactions which are like dividend payouts to the foreign shareholders, ESOP payments, tax payments, etc. So while we
Okay.
understand that, yes, sir, you were saying?
Please.
Yeah. So while we understand the complexity involved in the capital account
Carry on.
transaction, it is majorly divided into post and pre. One is during the remittance, what all documentation and checklist is required, and secondly, after the remittance also there are certain reporting formalities. So here in ICICI, the edge which we provide is that along with the branches, we have a dedicated capital account desk which addresses all your pre and post transaction compliances. So along with the branches, we have a dedicated team because we understand this product is niche even to the companies. They don't do this transaction regularly. So we have a dedicated team. All the transactions, all the reporting queries can be addressed. Secondly, we do also have seamless end-to-end fund transfer. We ensure that all the KYC telexes or the SWIFT messages which we get while receiving the FDI, we ensure that there is a seamless end-to-end fund transfer for the companies and also a competitive FX rate, since the value, the quantum at times is very huge for capital account transaction. And also to highlight, in case where an Indian company is receiving FDI and it is not having a capital bank account with ICICI, we can still handle such FX conversion for the client. We will convert the FX and we will credit the another bank's account. So it is not that necessary that the customer should have bank account with ICICI in case of FDI involved. Secondly, when it comes to, like I said, in capital account, there's a lot of post-transaction compliance. So I say there is an automated mailer which goes to the resident individual or the Indian companies who is undertaking the ODI and FDI. We send out timely reminders to the companies for the regulatory filing. Any help in the regulatory filing, we have a dedicated desk. We also have a pre-verification portal for FDI, meaning for FDI, there are a lot of reporting. So in case customer wants to vet the document before their final submission to RBI, we have a portal dedicated for verifying their draft as well, which is a very first step in the industry, where we have a dedicated portal for reviewing the draft documents. As we understand, to get some document signed from a foreign investor is, it's time consuming. You cannot go back is something is left, and you cannot go back to your foreign investor again and again. Hence we have this pre-verification services also, and that is comes with no cost. So it is free for all. The even consultant can upload documents. Secondly, we have a booklet as well for FDI, where we have tried to give all the necessary information for companies who are planning to receive FDI. And we are also launching our ODI booklet by this month end, which will be a comprehensive guide for any new companies or any new LLP who is planning to undertake the investment. Coming to digital solutions, we do have for the invert credit, we have a digital platform where customer can, submit the necessary request letter online, and the transaction can be routed seamlessly without the intervention of the branch. So this we have for FDI credits. And in a capital account, the KYC and FRC issuance is very important, because the regulatory filing for FDI gets stuck if the FRC and KYC is not issued by the banker. So we issue the KYC FRC immediately on the day when it is remitted. Even for non-ICICI bank customer, if we are handling the FDI credit, the FRCs and KYC is issued promptly. And the pre-verification portal is also a digital platform. So this is a digital solution which we provide. And lastly, we do have a field team which is present everywhere in the larger cities. So even a physical meeting or a quick turnaround time is possible. We have a centralized team along with a field team which we can, can meet, and we can have the complexity solved and any structuring related queries addressed. Yes, sir. That's from my side.
Thank you. Thank you. Thank you, madam, very much. You just tell me the ECB, external commercial borrowing, how you are
So
helping.
1 second. There is some
External commercial borrowing, how you are helping the people. If anybody coming to you for external commercial borrowing, how your ICICI bank can help him? Have any view on that? Okay, then I think we have overstretched our time.
So am I guess I lost, there was a, hello?
I'm just asking you, madam.
Yeah,
If
yeah, I
any
heard the
customer
question.
want to come to you for external commercial borrowing, how your bank can be helpful to them?
Yeah, so we will firstly assist in all the prerequisite of the documentation which is required for ECB. For ECB, there is a request which is submitted
Okay,
to
there is no
RBI.
problem. That is no problem. How you manage? Well, okay, he will go to RBI. Okay, then
Yes, and because every ECB, the RBI is required to allot the loan request number. So once the
okay.
application is submitted, we try to get it expedited as early as possible so that the LRN
How
is
much
issued.
actually? Only one point is how much time it will take from your bank to get the
So
ECB
once
approved.
Yeah, once the documents are in order, which takes 2 to 3 days, in a week's time we get the LRN from the RBI. We from our side
Okay,
ensure
thank
that the
you very much.
document are clean so that RBI
That's all document as per the requirement of the RBI. No problem for that. Thank you very much. At the end, I am thankful to the ICICI Bank for giving us the opportunity to host this program for export financing. I think program was very nicely designed, and I think there will be a good feedback from our entrepreneurs who are listening to this program. So I'm thankful to them. I am also thankful to the main speaker of the ICICI, Mr. Goran, who has covered very nicely the pre-shipment and post-shipment RBI guidelines, and also ECG, and also factoring. I think it is also news to the our listener that the factoring is also very useful aspect, and they can avail it from the factoring system also, beside the banking system. So I am also thankful to Mr. Santosh Pandey, who is a product manager the ICICI product, what ICICI is doing and how they are helping the customer. I think it is very nice to hear from him that even the bill, if he is not a customer of the ICICI bank, if they have a LC document, is as per the document, all documents are available with them as per the LC term, they can come and discount them. I'm also thankful to Madam Hiral, who has nicely covered the capital account and especially ECB. So I'm thankful to them. Above all, I'm thankful to my team who is behind the screen, Mr. Rajan, Mr. Ayush, Mr. Devesh, Mr. Lokesh, Mr. Dishwar, and Rahul. So I'm telling you, India is a merchant banker, investment banker, providing DPR and other information. So any help is required from the research in India to avail the export credit, we are at their disposal, and ICICI Bank can be helpful to them. With this word, I am thankful to all my participants, to our eminent speakers, to all the person who are listening to them. I am only request to give your sincere feedback to us so that such program can be held. As I already informed you, beside the Association for Financial Advisor of India, mostly every week we are doing this webinar. They're on different subjects as per demand of the members. So we are thankful to you, and thank you, thank you, thank you all. Thank you very much.
Thank you, sir. Thank you so
Thank you,
much.
sir.
Thanks.
Thank you.
Thank you, sir. Thank you very much for participating.
Well, Gupta sir, thank you for moderating the session also. Thank you, sir.
Thank you, thank you, Mr. Rajan. Thank you very much.